Arbitrage trading may seem purely data-driven and rational, yet psychology has a profound impact on market dynamics and outcomes. Traders who understand and manage these psychological factors gain an edge, navigating the biases and emotional challenges that can undermine even the most data-based decisions. In this chapter, we'll explore the role of behavioral finance in trading, examine key cognitive biases, and discuss the importance of discipline, emotional intelligence, and resilience. Section 1. Behavioral Finance Insights. Behavioral finance is a field that examines how psychological factors shape financial decisions. Unlike traditional financial theories that assume rationality, behavioral finance acknowledges that emotions, biases, and social influences often drive market behavior. Understanding these aspects is essential for arbitrage traders, as markets frequently react to human psychology rather than strict fundamentals, creating price discrepancies. Behavioral finance offers a critical perspective on market movements. When traders misjudge values based on personal biases, prices deviate from intrinsic value, leading to arbitrage opportunities. For instance, in highly emotional markets, assets can become either overvalued due to hype or undervalued due to fear. By recognizing the psychological patterns driving these mispricings, traders can better identify and exploit arbitrage opportunities. Section 2. Key cognitive biases in trading. Cognitive biases are systematic patterns of deviation from rationality that affect traders' judgments. These biases, whether conscious or subconscious, influence how traders interpret information, assess risk, and make decisions. Understanding these biases allows traders to make objective, data-based decisions and avoid common psychological traps. Overconfidence bias. Overconfidence bias is one of the most prevalent biases in trading, where traders overestimate their knowledge, skills, or control over outcomes. Overconfidence can lead to excessive risk-taking and persistent market mispricing. For example, a trader might feel they have superior insights and thus ignore warning signs, creating overbought or oversold conditions that present arbitrage opportunities for other, more cautious traders. Addressing overconfidence. A trader aware of this bias can adopt a critical mindset, continuously questioning assumptions and seeking counterpoints to reinforce balanced decision-making. Anchoring bias. Anchoring bias occurs when traders rely too heavily on the first piece of information they encounter. For instance, if a stock was once priced high, a trader may irrationally use this price as a reference, holding on to it despite market changes. This often leads to delayed reactions to new information, allowing arbitrageurs to profit by acting on current, accurate data instead. Mitigating anchoring bias. Traders can combat this bias by regularly updating their analysis based on the latest data rather than past values, creating a more flexible, responsive strategy. Herd behavior. Herd behavior is the tendency to follow the majority, often leading to market bubbles or crashes. In bull markets, herd behavior can inflate asset prices, creating overvaluation. Conversely, in bear markets, it can lead to panic selling. For arbitrage traders, understanding herd behavior provides a strategic advantage by allowing them to anticipate corrections when prices deviate far from fundamentals. Navigating herd behavior. Traders who keep an independent, data-driven approach can avoid falling into the herd mentality, instead capitalizing on the inevitable return to intrinsic value. Loss aversion. Loss aversion is the bias that makes individuals fear losses more than they value equivalent gains. This can lead to irrational decisions, like holding on to losing positions too long or selling winning positions prematurely. Arbitrage traders can benefit from others' loss aversion, as it can cause temporary market imbalances. Overcoming loss aversion. To manage this bias, traders need to establish and strictly follow stop-loss policies, helping them limit losses without emotional interference. Emotional influences in trading. Emotions such as fear and greed often dominate trading decisions. When unchecked, these emotions can cloud judgment, leading to impulsive decisions that diverge from a trader's strategy. Emotions frequently drive market trends, affecting everything from asset prices to trading volume. By understanding these emotional patterns, arbitrage traders can better anticipate and react to market extremes. Fear. Fear is a natural reaction to market volatility and can lead to sudden price drops when panic sets in. For example, during market corrections or economic downturns, fear can cause rapid sell-offs, creating undervalued assets. Traders who recognize fear-driven trends can profit from buying undervalued assets, anticipating eventual recovery. Greed often manifests during market bubbles, where traders become overly optimistic, driving prices well above intrinsic value. For arbitrage traders, markets driven by greed present opportunities to short overvalued assets, profiting as prices correct. Managing emotional reactions. To maintain control over these emotions, traders can develop habits such as taking regular breaks, reflecting on decisions, and using data-driven methods to stay grounded. By setting clear goals and risk limits, they can make consistent decisions without yielding to the emotional swings of the market. The importance of discipline. In arbitrage trading, discipline is key to sticking with a strategy and avoiding impulsive decisions. Disciplined traders follow structured plans, only deviating when rational analysis supports a change. A lack of discipline can lead to excessive trading, missed opportunities, or, conversely, irrational holdouts. Here's how disciplined practices can improve trading success. Structured decision-making. Structured decision-making involves creating a well-defined trading plan that includes entry and exit points, stop-loss levels, and profit-taking targets. This plan prevents impulsive decisions during market volatility, helping traders stay on course even when emotions are high. A structured plan acts as a safeguard against knee-jerk reactions. Routine and consistency. A consistent trading routine that includes pre-market analysis, daily goal setting, and post-market reviews enhances a trader's focus. This approach reinforces discipline, ensuring that traders enter and exit trades according to plan rather than market noise. Regular post-trade analysis helps identify areas for improvement, reinforcing habits that foster long-term success. Developing emotional intelligence. Emotional intelligence, EQ, is crucial in trading, as it involves the ability to manage one's emotions and understand others. High EQ can help traders maintain objectivity, manage stress, and stay grounded in their strategies. Traders with strong emotional intelligence tend to be more resilient and adaptable in fluctuating markets. Self-awareness. Self-awareness allows traders to recognize their own emotions and understand how they influence decision-making. By identifying emotions like frustration, excitement, or doubt, traders can pause and assess whether these feelings align with their strategy. Self-aware traders can recognize when they're drifting off course and take corrective actions. Self-regulation. Self-regulation is the ability to control impulses and stay composed under pressure. For traders, this means avoiding impulsive trades, maintaining focus on long-term goals, and adhering to established rules even when the market is turbulent. Social awareness and empathy. In trading, social awareness and empathy extend to understanding market sentiment and predicting collective reactions. For example, traders can gauge broader sentiment through news analysis, social media trends, and other sources. Anticipating public sentiment shifts allows traders to position themselves advantageously. Section 6. Combating cognitive biases. An essential part of trading psychology is actively working to overcome cognitive biases. Arbitrage traders who successfully counteract biases like anchoring or overconfidence can execute trades based on facts rather than perceptions, improving their accuracy and profitability. Overcoming anchoring bias. Regularly update reference points based on the latest data rather than relying on historical prices. Traders can benefit from setting alerts for asset price changes, ensuring they act on new information rather than outdated benchmarks. Countering confirmation bias. Traders can adopt a contrarian approach, actively seeking information that challenges their existing perspectives. Using tools to visualize data from multiple viewpoints fosters a balanced outlook, helping them make better informed decisions. Mitigating overconfidence. Regular self-assessment and constructive feedback are effective ways to keep overconfidence in check. Reviewing performance with an objective eye reinforces awareness of both strengths and areas for improvement, creating a more balanced view of personal skill. Section 7. Building psychological resilience. Psychological resilience, the ability to recover from setbacks, is critical for traders dealing with market volatility. Resilience allows traders to handle losses constructively, view them as learning experiences, and stay committed to their strategies without being swayed by emotions. Stress management techniques. Managing stress effectively is crucial for resilience. Techniques like mindfulness, regular exercise, and adequate rest help traders keep a clear mind. By managing stress, traders avoid burnout and maintain consistency even during demanding periods. Accepting setbacks without allowing them to impact long-term commitment is key. Traders who view losses objectively can analyze what went wrong, making improvements without losing confidence. Maintaining a long-term perspective. Focusing on long-term growth rather than individual trades reduces emotional strain. By adopting a broader view, traders avoid fixating on temporary setbacks, staying focused on overall success. The psychology of arbitrage trading encompasses self-awareness, emotional control, and resilience. By understanding cognitive biases, developing discipline, and building emotional intelligence, traders can strengthen their ability to navigate arbitrage opportunities with clarity and purpose. This approach not only enhances trading performance, but ensures a sustainable, balanced mindset in a dynamic financial environment.